Welcome back to the Deep Dive. It is Tuesday, February 25th, 2026. And I have to be completely honest with you right out of the gate.
Oh boy, here we go.
If you checked your portfolio app this morning, you might be needing a stiff drink right about now.
Or maybe two.
Yeah, or two. The markets today are, well, let's just call it lively, shall we?
Lively is a very polite, very British way of saying hemorrhaging. But sure, let's go with lively.
Hey, I'm trying to keep the morale up here, but
Yeah.
seriously, there is this chaotic energy out there today that we really need to unpack.
There really is.
It feels like you and I and everyone else are caught in a perfect storm. It is a double whammy hitting investors right in the face.
Right.
On one side, you have what everyone is suddenly calling the AI panic, and on the other, you have this renewed tariff tussle with the U.S. It just feels like the floor dropped out.
It does feel that way. And, the numbers aren't lying. This isn't just market sentiment or vibes. It is hard data.
Break it down for us.
Well, the Sensex plummeted over 1,000 points today, closing at exactly 82,225.900.
And if you think the broader market is bad, look at the tech sector. The Nifty IT index took a nearly 5% battering today.
5% in a single day for the IT index. That is just brutal.
It is massive.
That is not a standard correction. That feels like a total repricing.
It is. It is exactly the kind of drop that makes you question the underlying fundamentals of the market. And honestly, that is exactly our mission for this deep dive today.
Exactly. We need to parse the noise from the actual signal.
Right. Is this just a knee-jerk reaction to some bad headlines over the last 24 hours?
Or are we looking at a fundamental shift in how the economy is going to operate in 2026?
Precisely.
Because we are focusing strictly on actionable intelligence for you today. We aren't here to panic. We are here to understand. And we have a stack of sources today that is honestly fascinating.
It is a heavy news day.
We've got this viral report that completely terrified Wall Street and Dalal Street regarding AI.
Which we will get into very shortly.
Yeah.
It is quite the piece of reading, practically a horror story for the labor market.
Yeah, it really is. And then we have the confusion coming out of Washington, D.C. Trump lost in the Supreme Court regarding tariffs, but somehow the tariffs are still happening anyway.
We need to explain the legal gymnastics on that one.
Definitely, because I think a lot of business leaders are scratching their heads this morning.
It is a classic pivot. It involves a very old law that they just dusted off.
We also have some silent drama brewing at Tata Sons regarding the chairman's reappointment, which is entirely unexpected.
Very unexpected. Usually that ship sails very smoothly.
Plus a massive cybersecurity wake-up call involving a 72-hour digital arrest. It sounds like a nightmare straight out of a dystopian sci-fi movie.
And believe it or not, amidst all this red ink, we actually have some green shoots in real estate investment trusts.
So it is not all doom and gloom.
No. There is money being made, just not where you might expect it to be.
Okay, let's dive right into the beast that is eating the market today. Segment 1, the AI disruption, hype versus reality.
Let's do it.
So the main catalyst for today's bloodbath in IT stocks seems to be this new report from Citrini Research. It went completely viral over the last 24 hours, and apparently it really spooked investors.
It did.
What exactly does this report say? Because from what I've seen on the feeds, it paints a picture of the future that is, well, pretty dystopian.
Dystopian is absolutely the right word for it.
Huh?
This report isn't just your standard quarterly outlook. It is projecting ahead to 2028.
Okay.
And it is forecasting a scenario where global unemployment hits 10.2%.
10.2%. That is massive.
It is. But the real kicker is why it hits that number. They aren't predicting a standard recession caused by low consumer demand or a pandemic. They are predicting mass layoffs caused explicitly by AI.
So AI replacing software and delivery applications?
Yes, the robots actually coming for the jobs.
We have joked about it and theorized about it for years, but Citrini is saying it is actually here.
According to them, yes.
Yep.
And they aren't just talking about code generation or chatbots. They are forecasting mortgage defaults, private equity failures.
Wait, why private equity failures?
Because it is a cascading financial crisis. It is triggered by the fact that AI becomes so efficient that human labor in these white-collar sectors becomes completely obsolete.
No, I see.
Right, so if people don't have jobs, they don't pay their mortgages. If they don't pay their mortgages, the banks suffer.
The domino effect.
Exactly. If the consumer base dries up because no one is running a salary, the private equity firms that own the company selling to those consumers also collapse.
And this clearly hit a nerve today.
Oh, clearly.
Right.
Investors are already incredibly skittish.
Yeah.
We have been riding this AI hype wave for 3 years now. ever since the early ChatGPT days.
Right. Everything with AI in the name has had sky-high valuations.
Exactly. And now you have major voices like Christopher Wood from Jefferies. He is warning that the U.S. AI-driven trade is finally coming under the lens.
People are starting to ask the hard questions.
Yes. What is the actual return on investment? We are spending billions on chips and data centers, but where is the profit?
And more importantly, if the profit comes from firing everyone who is left to buy the product.
That is the trillion-dollar question.
Yeah.
But Christopher Wood did note that while the U.S. trade is under scrutiny, India's AI story is really just starting.
Okay, so show me the money, but also show me the sustainability. Here is where I want to push back a bit on the doom and gloom, or at least look at the other side of the ledger.
Okay, let's hear it.
We have the actual data from NASSCOM regarding the Indian IT sector. If the world is ending, nobody told the Indian IT services revenue projections.
That is the fascinating contradiction we are seeing today.
Right. On one hand, you have the panic from the Citrini report. On the other, you have the actual ledger.
NASSCOM is projecting IT revenue to hit $315 billion in FY26.
$315 billion.
Yes. That is up 6.1% year on year, and exports are forecast to rise to $246 billion.
So revenue's growing. 6.1% isn't explosive hypergrowth, but it is very healthy.
It is.
It certainly is not a collapse. It sounds like a steady, mature industry chugging along.
No, it is not a collapse at all. But, and this is the real aha moment for you if you are listening, the thing you really need to grasp to understand this market, you have to look at the headcount.
Okay.
You have to look at the relationship between the money coming in and the people being hired.
The hiring numbers, what do they look like?
Revenue is growing, right? But headcount growth is the lowest we have seen in years.
How low?
The entire industry is only adding about 135,000 net new employees.
Wait, let me pause you right there. So they are making significantly more money, but they aren't hiring more people at the same rate they used to.
That is the exact definition of nonlinear growth.
Nonlinear growth.
Yes. For decades, the Indian IT model was strictly linear. It was a very simple equation. You want 10% more revenue, you hire 10% more people.
Right. You need bodies and seats to write the code and manage the massive server farms.
Exactly. But that link has officially been broken. Companies are making more money without adding bodies at the same rate.
So this validates the efficiency of AI. The tools are actually working and making developers faster.
It does. But it also weirdly validates the fears in that Citrini report we just talked about.
Oh, I see. It validates the efficiency, which is fantastic for corporate margins today, but it validates the job stagnation narrative, which is terrible for the macroeconomy tomorrow.
Precisely. It is a massive double-edged sword. Investors love efficiency because it means better margins right now, but they fear the macro implications of low hiring, because that means lower consumption down the line.
And you see this tension reflected in the corporate voices, too. I saw C. Vijayakumar, the CEO of HCL Tech, came out and admitted it.
What did he say?
He said the industry is in a, quote, painful transition.
Painful transition. That is not sugarcoating it at all.
No, that sounds like a CEO who knows things are changing fundamentally and there is going to be some friction.
But he also explicitly rejected the obituary of the IT sector. He is essentially saying, we aren't dying, we are just changing.
The model is shifting from scale based on people to scale based on technology.
Right. And then you look at the buyers. The company's actually spending the money. Meta, Facebook's parent company, is doubling down.
Oh, yeah, I saw this.
They are buying AI chips from AMD in a deal worth up to $100 billion.
$100 billion. With a B.
That is the figure being reported. It is a staggering amount of money.
It really highlights that the massive infrastructure spend is still happening.
The big tech companies are betting the farm on this infrastructure. So the obituary of the tech sector is definitely premature. But the pain of transition for the average worker is very real. We are in the messy middle part of the adoption curve.
So for you, the investor listening to this, the main takeaway is don't panic sell just because of a dystopian research report.
Right.
But you do need to understand that the old business model of hiring thousands of freshers every year might be over.
Look for the companies that are successfully decoupling their revenue from their headcount. That is where the real margin expansion will come from in the next 5 years.
If you see a company growing revenue by 10% and headcount by 0%, that company has figured out the AI integration.
Exactly. That is the gold standard right now.
Okay, let's pivot from the digital war to the actual trade war. Segment 2, geopolitics and trade.
The tariff war 2.0.
This situation with the U.S. tariffs is honestly incredibly confusing today. I saw the headline this morning, Trump lost in court, but the tariffs are active. Help us out here. It feels like a legal thriller.
It is a classic case of executive power shuffling.
Cool.
So let's rewind a little bit to set the stage.
Okay.
President Trump tried to impose these massive global tariffs using something called the International Emergency Economic Powers Act, or IEEPA.
Right. Now, this is a law that is usually used for hard sanctions against rogue states or during actual wars.
So it's a heavy-hitting national security tool.
Exactly. And the U.S. Supreme Court looked at his use of that act and basically said, no, you cannot do that. That is an executive overreach. Trade deficits with allies are not a national emergency in the way the law was intended. So they struck down the duties. That should have been the end of the story, right? The tariffs are dead.
They struck it down under that specific law, yes. But the Trump administration didn't just pack up and go home. They immediately pivoted to a completely different law, one that hasn't been used much in recent history.
Which one?
Section 122 of the Trade Act of 1974.
Section 122. Okay, I am guessing this one isn't about wartime emergencies.
No, this one is specifically about the balance of payments.
Balance of payments.
Yeah, it allows the U.S. president to impose temporary surcharges, basically import taxes, to deal with large balance of payments deficits.
And since the U.S. runs a massive trade deficit with almost everyone, the administration argued this applies perfectly.
Exactly. So they effectively just swapped out the legal justification on the paperwork and kept the exact same policy. As of Tuesday, a 10% global import tariff has officially kicked in.
10% on everything.
Yes. And the White House is already signaling they're looking to bump that up to 15%.
That is so aggressive. A 10 to 15% blanket tariff is going to hurt supply chains everywhere. It is essentially a massive tax on everything entering the United States.
And it gets worse. I've seen reports that they are considering even more new tariffs under Section 232.
Section 232?
Yes, that is the National Security Clause. They are looking at targeting a half dozen specific industries with that one.
So despite the massive Supreme Court loss, the protectionist wall is still going up.
The legal mechanism changed, but the economic reality for exporters remains exactly the same. It just got much harder and more expensive to sell anything to America.
How is India reacting to this? I mean, usually when the U.S. sneezes, the global supply chain catches a cold. Are we seeing panic in New Delhi? Are exporters freaking out?
Surprisingly, no. There is no panic. We heard from Commerce Minister Piyush Goyal at the Manthan 2026 summit.
What did he say?
His reaction was very stoic, very measured. He basically said India is hitting pause on all trade talks with the U.S. until there is some actual clarity.
That makes total sense. Why negotiate a deal when the rules of the game are changing every 24 hours?
Exactly. You don't sign a long-term contract when the other party is literally rewriting the legal terms in real time.
But there is a bigger story here, isn't there? Something else Goyal said.
Yes. The bigger news, and this is where it gets really interesting for anyone involved in investing in manufacturing, is what Goyal said about China.
The China pivot. I caught this headline and I honestly thought I misread it.
I don't blame you. It is a massive shift. For the last few years, the official stance on Chinese investment has been a very hardline no.
Right. Keep them out. Security risks. Border tensions.
We froze visas for their engineers. We froze their capital investments. But at Manthan Goyal used very specific words. He used words like calibrated and step-by-step regarding easing investments from China.
Calibrated easing. That is heavy diplomatic speak.
It translates roughly to, we need their money and their tech right now.
It is an admission of economic reality, isn't it?
It absolutely is. Look, India desperately wants to be a global manufacturing powerhouse. We want to be the ones to replace China as the factory of the world.
Right, in India.
But to actually boost domestic manufacturing, especially in complex sectors like electronic smartphones and high-end components, India needs Chinese capital. And more importantly, we need Chinese technology.
Because you can't just build a massive smartphone screen factory in India out of thin air. You need the intellectual property and the specialized machinery that right now mostly comes from China.
Exactly. You cannot skip the intermediate step of tech transfer. Goyal clarified that it is not a complete ban anymore. It is an accelerated approval process for Chinese investments that help build domestic capacity.
This connects directly to what some corporate leaders are saying, like Dixon Technologies.
Yes. Their vice chairman, Atul Lal, called this the, quote, why buy moment for electronics manufacturing.
The why buy moment.
Meaning, why buy the finished product when you can finally build it here? He sees this policy shift as a massive inflection point.
So if you are investing in Indian manufacturing or electronics companies, names like Dixon or Amber or Surma, this sudden thaw with China is actually a massive tailwind.
It is a huge tailwind. It removes a massive bottleneck in the supply chain.
It suggests the government is finally prioritizing economic pragmatism over pure geopolitical posturing.
They want the factories running. Even if it means letting some Chinese capital in through the side door, it is a very clear sign that Make in India is maturing from a political slogan into a functional supply chain reality.
Fascinating stuff. So we have AI fundamentally changing the labor market, and we have the government actively tweaking geopolitical alignments to save local manufacturing.
It is a lot of moving parts.
Let's move to segment 3, corporate governance and strategy. And we absolutely have to talk about the giant elephant in the room today, Tata Sons.
Ah, the Tata mystery. This is the story that everyone in the corporate world is quietly whispering about over coffee today.
The board met on Tuesday. And everyone just naturally expected them to rubber stamp the reappointment of N. Chandrasekaran, or Chandra, as he is known for a third term as chairman.
Everyone assumed it was a done deal.
He has been incredibly successful. The group stocks are generally up, but they didn't do it. They deferred the decision entirely.
Which, in the notoriously tight-lipped world of Tata, is like setting off a firework in a quiet library.
Exactly. They do not do public drama. Stability is literally their brand.
They plan succession years and years in advance. So for them to suddenly say, we need more time, is a massive signal of internal friction.
So why the hesitation? Chandra has been the very public face of the modern Tata. He modernized the entire group structure. He settled the messy Docomo dispute. He bought Air India back.
He has done a lot of heavy lifting. But if you dig into the sources and the back channel chatter, there are clear friction points right now.
What kind of friction?
It seems to boil down to a fundamental clash between the trust structure and the corporate structure.
Explain that dynamic for us.
Well, the Tata Trusts own the majority of Tata Sons. They focus on philanthropic goals. They want stability and steady, predictable dividends to fund their charities.
Right.
The corporate structure, which Chandra runs, has been leaning heavily into aggressive expansion and risk-taking lately.
You are talking about the massive digital bets.
The digital bets are definitely the sore spot here. Tata Neu, the super app, Tata Digital. There are serious performance concerns there.
They acquired all those unicorns, right? Big Basket and one in Milliken.
Yes, and those acquired entities are still posting significant losses. They are burning through capital.
And the Tata Trusts rely on those dividends. So if the operating companies are burning cash on expensive digital customer acquisition, that dividend flow gets threatened.
Precisely. It becomes a deeply philosophical question for the board. Are we a high-growth tech conglomerate that burns cash for market share? Or are we a steady-yield industrial giant?
Because the trusts use those dividends to fund cancer hospitals and rural development programs, they aren't venture capitalists.
Right. They might be looking at the billions going into super apps and asking, is this really the best use of our capital right now? The deferral of this vote strongly suggests the board and likely the trusts want to have a very serious conversation about the long-term strategy.
Is aggressive growth at all costs really the Tata way?
That is the question being asked.
It creates a lot of uncertainty, though. I mean, if they don't reappoint him, who steps in? But for now, it is just a deferral. But for you as an investor holding Tata Group companies, TCS, Tata Motors, Tata Steel, does this leadership drama actually matter?
In the very short term, probably not much. The individual operating companies are professionally run by their own CEOs. TCS isn't going to suddenly stop coding because the chairman of the holding company is in a state of limbo.
Right, the day-to-day operations are insulated.
But long-term, absolutely it matters. The chairman of Tata Sons sets the broad capital allocation strategy for the entire group.
So if the next chairman, or even a chastised Chandra, pulls back on digital spending, that completely changes the growth profile of the group?
It might mean higher, steady dividends for shareholders, which value investors will love. But it also means much slower growth in these new digital sectors.
It is definitely a space to watch closely. Speaking of burning cash and losses you mentioned, the broader startup ecosystem is generally under the microscope right now, too.
It is. The era of infinite patience for high burn rates is officially over. We are seeing a general, aggressive questioning of losses at all new ventures.
The market is finally demanding actual profitability and not just vanity metrics like gross merchandise value.
Exactly. The Tata situation is just the highest profile and most traditional example of this very modern trend. Investors want to see the path to cash flow positive.
Which brings us quite neatly to the financial sector, where money is moving fast but not always safely. Segment 4.
The financial sector, risks and opportunities.
I have to tell this story from the sources because it is genuinely terrifying. The digital arrest scam.
This is a story that every single listener needs to pay close attention to. Because it is sophisticated, it is cruel, and it is costing everyday people millions.
So the details. A victim lost 5.85 crore rupees.
Almost 6 crore. Gone.
Scammers contacted him via Skype. They posed as high-ranking police officers and officials from the CBI. They claimed his digital identity was used for massive money laundering. Drugs, terror, funding the usual heavy scare tactics.
It is always the same playbook to induce panic.
But here is the absolute kicker. They kept this man under video surveillance for 72 hours straight.
3 full days. Imagine the relentless psychological pressure.
3 days. They called it a digital arrest. They told him he couldn't leave his house. He had to keep the Skype camera on at all times so they could watch him. And they psychologically broke him down until he finally transferred the money just to verify his innocence.
It is literal psychological warfare.
And the reason we are discussing this in a financial deep dive and not a true crime show is because of the massive banking implications here. This particular case involved IDFC First Bank.
Right, and the bank is publicly saying, look, this is not our fault.
Exactly. IDFC First Bank issued a formal statement saying this is a customer-level fraud. It is not a systemic technical breach of their banking systems.
Meaning, the customer technically authorized the transfer himself. He logged into his account, he entered his password, he received and entered the OTP.
From the bank's purely technical perspective, the security system worked exactly as it was designed to.
But the Supreme Court isn't buying that technicality.
No, they are not happy with that answer at all.
The Supreme Court is actively stepping in now. They are demanding a comprehensive framework for coordination between the banks and the telecom companies.
They're essentially asking the banks, why can't you stop this? Why can't your advanced systems detect that a customer is on a frantic 72-hour Skype call while simultaneously draining their life savings to an unknown account?
And this signals a massive coming wave of regulatory compliance costs for the banking sector. Banks are going to be forced by the courts to invest heavily in behavioral fraud detection.
Detection that goes far beyond just asking, did you enter the correct OTP?
Exactly. They need to build AI models that can actually detect coercion and unusual behavioral patterns in real time.
That is going to be incredibly expensive for the banks to implement. Real-time behavioral analysis on millions of transactions is not cheap.
Very expensive, but totally necessary. Think about it. If people lose trust in the basic safety of the digital banking infrastructure, the whole digital India stack takes a massive hit.
Right. If you cannot trust that your life savings are safe from a fake Skype call, you will just stop using the digital tools altogether.
Exactly. Trust is the only currency that actually matters in banking.
Moving from digital scams to the actual macroeconomic health of the banks, we are starting to see some real stress signals in the data, aren't we?
We are. The liquidity coverage ratios, or LCR, have dropped noticeably across several major banks.
Like who?
Institutions like HDFC and Punjab National Bank. They're all seeing this crucial liquidity buffer shrink.
And just to clarify for everyone, that is because deposit growth is lagging behind, right?
Exactly. Credit growth, which is the banks loaning money out, is moving very fast, and everyone wants a loan right now. But deposit growth, which is the money coming into the bank, is incredibly slow.
Because people aren't just keeping their cash in low-yield savings accounts anymore. They are putting it directly into the market. Well, they were until today's crash anyway.
Right. So the banks are essentially running short on everyday liquidity. Their credit deposit ratios are running very high.
So what are the banks doing to fix this cash crunch?
They are rushing to issue certificates of deposits, or CDs. They're using these to quickly plug the liquidity gap. It is a mad scramble for cash.
But doesn't that cost them more?
Yes. This scramble usually leads to higher interest rates on those deposits, which directly hurts the bank's net interest margins.
So banking stocks might face some serious headwinds going forward, not just from the general market sentiment, but from these very real internal liquidity crunches.
It is definitely a macro factor to watch.
But amidst all this banking stress, there is one area of finance that is absolutely booming right now: real estate investment trusts, or REITs.
This is a really interesting bright spot in the data. While the stock markets are incredibly volatile, real assets are having a massive moment.
Real assets?
Yes, REITs and Inviants, which are infrastructure investment trusts, raised roughly 37,742 crore in FY26.
37,000 crore. That is the highest fundraising we have seen in that space since FY18.
It is a phenomenal amount of capital.
Where is all that smart money actually going? Is it just pouring into traditional generic office parks?
It is going into office parks and infrastructure, yes.
Yeah.
But there's a very important nuance here. The flex space model is surging.
Wait, you mean like WeWork? I thought the WeWork model completely collapsed.
The specific company WeWork had massive corporate governance and valuation issues, yes. But the actual model of flexible working spaces hasn't died at all. It just evolved and matured. Corporations simply do not want to sign rigid 10-year commercial leases anymore. They want total flexibility. They want to be able to scale their office footprint up or down based on things like AI disruption.
Right, if you might need half the headcount in 3 years, you don't sign a 10-year lease today.
Exactly. So the REITs that offer these flex spaces in multi-city deals are seeing huge institutional demand. It is the core WeWork model, but it is finally being run by financially prudent landlords instead of overly aggressive tech bros.
That makes a lot of sense. So the smart money is moving heavily into physical hard assets that offer maximum flexibility. In a volatile world, you want something concrete, but you want the ability to pivot quickly if the ground shifts under you.
Flexibility is the ultimate premium right now.
Let's move on to segment 5, policy infrastructure and the broader economy. We have a brand new asset class being officially born in India, carbon.
Yes. India is finally launching its very first official carbon trading program.
It is about time.
The first compliance phase runs from April 2025 to March 2026. This is a very big deal for the long-term industrial economy.
But I read the details, and there is a pretty massive catch here. The biggest polluters aren't even invited to the party yet.
That is true. It is being treated as a soft launch.
Tough launch.
The Bureau of Energy Efficiency is rolling it out, but the steel and fertilizer sectors, which are absolute heavy hitters for industrial emissions, are completely excluded from Phase 1.
Why leave them out? Those are exactly the industries you want to regulate and incentivize to clean up.
It is likely to give them necessary time to adjust their operations. These are massive, complex industries that physically cannot pivot their energy mix overnight without causing huge economic shocks.
Fair enough.
Also, you have to remember the geopolitical context. The European Union has this new CBAM tax, the Carbon Border Adjustment Mechanism.
Right, the carbon import tax.
India desperately needs a functional domestic carbon market to counter that European tax.
How does that work?
If Indian manufacturing companies are already paying a price for carbon here domestically, they might be able to get a compliance offset when they export to Europe.
Oh, I see. So this soft launch is really just setting up the internal plumbing for that international system.
Exactly. It is about creating the legal and trading mechanism now. So we can eventually tell Europe, look, we are actively pricing carbon. You need to back off your import taxes.
Got it. So start small, get the actual trading mechanism working smoothly without crashing the market, and then eventually bring in the giant steel plants.
That is the strategy.
Also, in infrastructure news, the telecom sector is finally getting some clarity.
Yes. TRAI has officially recommended a new spectrum auction for FY27.
Why does that matter today?
This is crucial because telecom companies need to know the exact regulatory roadmap for their 6G development and network expansion.
Right, they plan CapEx years in advance.
Exactly. It gives them a concrete timeline for their massive capital expenditure. The telecom sector hates regulatory uncertainty more than anything else. So just having a firm date on the calendar is very good news for those stocks.
And what about the average worker in the broader economy? We spent a lot of time talking about the scary AI layoffs projected for the future, but right now in 2026, what is the actual pay and job situation looking like?
It is actually stabilizing nicely. The Great Resignation is officially over.
Finally.
Attrition rates have dropped down to 16.2%. People are generally holding on to their current jobs.
Probably because they're reading those terrifying Citrini reports about AI taking all their jobs.
A fear is a highly effective retention tool. But seriously, wages are still rising.
By how much?
The average corporate pay hike is projected at 9.1% for 2026. That is actually up slightly from 8.9% last year.
So companies are still willing to pay a premium to keep their top talent, but the constant job-hopping churn has finally stopped.
That is exactly it, which is great for overall corporate stability. Even if the total wage bill is getting heavier for the CFOs, it means major projects aren't constantly stalling out just because key people are quitting every 6 months.
Stability is good. Let's hit segment 6. Other notable mentions. Just a few quick hits that popped up in the sources today that you should know about. First up, a geographic name change.
Yes, the Union Cabinet officially approved renaming the state of Kerala to Keralam.
Keralam.
Yes, it is a move to culturally align the English spelling with the actual Malayalam pronunciation.
Cultural alignment? Good to know for any official filings. And something much more serious, aviation safety.
Right. Following a very tragic fatal crash in Jharkhand recently that involved a private aircraft, the DGCA is significantly tightening the rules for non-scheduled operators.
By non-scheduled, you mean private jets and charters. What are they actually changing?
They are now legally demanding public disclosure of aircraft maintenance history, and they're introducing a new safety ranking mechanism.
Basically a scorecard.
Exactly. If you are chartering a private plane for business, you should be able to clearly see its objective safety score before you board. It is a transparency move that is honestly long overdue in that industry.
And finally, let's look at commodities. If you are wondering why buying jewelry is getting so incredibly expensive lately.
Gold is just skyrocketing right now. It is trading around 1,058,603 rupees per 10 grams.
1,58,000 rupees. That is insane.
It really is. And oil is hovering stubbornly at around $72.1 a barrel.
Why does that combination matter so much?
The big macroeconomic problem is that when both gold and oil are high at the same time, India's overall import bill absolutely balloons.
Because we import massive amounts of both.
Right. This dramatically widens the national trade deficit, which then puts serious downward pressure on the rupee.
It all connects.
It does. It connects right back to why the government is so desperate to boost exports and local manufacturing with that China pivot we discussed. We need dollars coming in to pay for all this expensive gold and oil going out.
Okay, let's take a breath and unpack all of this. Or rather, let's wrap this up. We have covered a massive amount of ground today. From the AI panic, to the tariff wars, to the quiet corporate drama at Tata.
It has been an incredibly heavy day for financial news.
So what does this all actually mean for you? If I had to summarize the overall vibe today, it feels like extreme volatility is just the new normal, but underneath all the daily noise, there are massive structural shifts happening.
That is the absolute key takeaway. Do not get distracted by the daily Sensex number flashing red on your screen. Look at the underlying structural shifts.
Like what?
The shift to AI efficiency, companies figuring out how to make more money with fewer people. The shift to real asset financialization through those REITs. The massive shift in trade policy, where we are pragmatically engaging with China again to boost manufacturing. Those are the long-term trends you can bet on.
The Citrini report might scare you to death about 2028, but the NASCOM numbers show that actual money is still being made right now in 2026. It is just being made differently.
Exactly. The game is changing, but it isn't ending.
Okay, as heavily requested by our regular listeners, let's do the deep dive top 10. These are the 10 specific developments from today's sources that are most relevant for the long-haul investor.
Let's run through them.
Number 1. AI efficiency versus disruption. The IT revenue is officially decoupling from headcount. This is the nonlinear model in action. If you are investing in the IT sector, you need to look for revenue growth, not hiring growth.
Number 2, trade policy volatility. We have definitively moved away from rules-based trade to executive order tariffs. The U.S. Section 122 action proves that global supply chains need to be diversified immediately. You simply cannot rely on a stable, predictable tariff regime anymore.
Number 3, the China thaw. This is huge. India's calibrated opening for Chinese FDI in the electronics sector is a massive geopolitical signal. It heavily boosts the long-term prospects for domestic manufacturing companies like Dixon Technologies.
Number 4, real asset financialization. The record fundraising in REITs and invitees hitting over 37,000 crore signals a major structural shift. Infrastructure funding is rapidly moving away from traditional bank loans and directly into the public markets.
Number 5, the commercial real estate pivot. The institutional demand is entirely for flex spaces, now not rigid long-term leases. The corporate office market isn't dead at all. It has just become much more fluid.
Number 6, cybersecurity liability. The 72-hour digital arrest scam is a major regulatory tipping point. You should expect much higher compliance spending for banks and significantly stricter liability frameworks mandated by the Supreme Court.
Number 7, the carbon economy. The launch of India's carbon trading scheme is officially here. Yes, it is starting soft by excluding steel, but it starts a brand new, massive compliance and trading cycle that will eventually impact all heavy industry.
Number 8, credit crunch risks. The shrinking liquidity coverage ratios in major banks are a flashing warning sign. Banks are running short on deposits compared to credit. This clearly signals much tighter lending conditions ahead.
Number 9, commodity inflation. Gold hitting 1.58 lakh and steady oil prices are severely impacting the current account deficit. This is a very real macro headwind for the currency that importers need to hedge against.
And number 10, Tata's governance test. The board's highly unusual hesitation on leadership isn't just corporate gossip. It signals a potential major strategy shift from growth at all costs back to sustainable profitability, especially regarding their expensive digital venture bets.
There you have it. The world is chaotic, the markets are bleeding red, but the underlying trends are very clear if you know exactly where to look.
Keep your head down, ignore the panic, and keep your eyes firmly on the data.
Absolutely. And to leave you with one final thought before we go today, we talked a lot about AI replacing human labor to drive corporate margins. But if AI becomes so incredibly efficient that it hollows out the middle class, as that Citrini report predicts who exactly is going to buy the products that these highly efficient companies are making, it is the ultimate paradox of hyper-efficiency. Efficiency creates profit today, but if it destroys the consumer base, it destroys the profit tomorrow. Something to mull over as you watch the markets this week. We will catch you in the next deep dive.